All right, today we're going to break down a really fascinating financial strategy I came across in a recent investment memo. This isn't your typical long term buy and hold kind of thing. Nope. This is a short tactical maneuver, what you might call a financial precision strike. So let's kick things off with a question that kind of flips the usual investing advice on its head. We're always told that profit comes from taking on risk, right? But what if? What if you could actually find profit by strategically and very cleverly navigating around known risks? That's the big idea we're going to unpack today. And the target for this whole operation is a company we all know, obviously, Visa. But here's the crucial part. This is not a bet that Visa stock is going to shoot to the moon. Not at all. It's actually a very specific, time-sensitive bet that Visa stock will just stay stable, that it won't do anything crazy for a little over a month. So how in the world do you make a bet like that? Well, it's done by selling what's called a cash-secured put option. Now, the easiest way to think about this is that you're basically selling an insurance policy on Visa stock. You get paid a fee, which is called a premium, right up front. And in exchange, you're just agreeing to buy the stock at a specific lower price, but only if it drops that far by a specific date. Okay, let's look at the actual numbers here from the memo. The stock, of course, is Visa, trading around 334 bucks. The agreement price, or the strike price, is a promise to maybe buy it at $300. Now, the key here is the timeline. This is set for future date, expiring in just 48 days on January 16th, 2026. And for selling this insurance policy, the person making the trade collects about $1.50 per share right away. And that brings us to a really important concept, the downside buffer. This is just a fancy way of saying your margin of safety. It's the percentage the stock can fall before you even start to lose a single penny on this trade. And for this Visa trade, that buffer is a pretty hefty 10.7%. Just let that sink in for a second. For this trade to actually lose money, Visa's stock, a massive blue chip company, would need to crash by almost 11% in just 48 days. That's a really substantial cushion. So you're probably asking, why so confident Visa won't fall that much in that specific time frame? Well, it all comes down to the core strategy, which the memo calls timeline arbitrage. The whole game here is about finding a quiet 48-day safe zone on the calendar, one that's deliberately positioned to avoid any major turbulence. Now, this is where it gets really clever. Look at this timeline. The trade gets put on right here, November 29th. The whole mission ends when the option expires, right here on January 16th. And check out what happens just after that date. First, you've got the Q1 earnings report. That can always make a stock go wild. And then, a major deadline in the Department of Justice's antitrust case against Visa. This trade is specifically designed to get in and get out before either of those big, known risk events. And I just love this analogy the memo uses. It perfectly explains the idea. The entire strategy is designed to step off the train right before it hits a potential volatility wall. You collect your fee, and you're long gone before the track gets bumpy. It's brilliant, really. So we know the timing is absolutely key. But beyond that, the whole idea is built on three core reasons why that 10.7% drop is just, well, very unlikely inside this 48-day window. You can think of them as three totally separate safety nets under the stock price. So here are those three layers of defense. First up, you've got a fundamental floor. This is based on strong holiday spending data and some new developments in Web3. Second, there's valuation support. Basically, at $300 a share, Visa starts to look like a real bargain to big institutional buyers. And finally, there's a technical fortress, which means the stock chart itself shows that historically, buyers love to step in right around that $300 level. Let's dig into that valuation support for a sec. This chart shows Visa's price-to-earnings ratio. It's just a common way to measure if a stock is cheap or expensive. You can see that over the last 5 years, it's typically traded at about 30 times its earnings. Well, if the stock were to fall to that $300 strike price, its PE ratio would drop all the way to 25. That would make it way cheaper than its recent average. The theory is that big money managers would see that as a screaming buy, and they'd start scooping up shares, which would help support the price. And here's that technical fortress we mentioned. For people who analyze stock charts, that $300 level has acted as a huge floor for Visa stock in the past. It's what they call a double bottom, which is a pretty powerful signal that suggests sellers are getting exhausted and buyers are taking control around that price.
So that strike price wasn't just picked out of a hat. It lines up perfectly with a known battleground where buyers have a history of winning.
Okay, so we've covered all the risk management, the timing, the safety nets, but what about the reward? I mean, what's the payoff here? Let's switch gears and look at how this strategy actually aims to turn that short 48-day period into a really solid stream of income.
The memo calls this the yield boost calculation, and it's a pretty straightforward way to figure out the total return. First, that $1.50 premium you collect gives you a 0.5% return in just 48 days. If you stretch that out over a full year, annualize it, that comes out to about 3.8%. But here's the really clever part. The cash you have set aside as collateral for the trade isn't just sitting there doing nothing. It's earning interest, let's say around 4%, in a super safe account. You just combine those two income streams, and that's how you get your total potential yield.
And this comparison really puts it all into perspective. The total annualized yield for the short-term trade comes out to about 7.8%. That's nearly double the 4% yield you'd get from a 10-year U.S. Treasury bond, which is what everyone considers a safe return. So this strategy is targeting way more income, and it's all done by finding and exploiting that quiet 48-day window on the calendar. So let's just boil this all down to the final takeaway. What is this strategy really? At its core, it's a highly disciplined, probabilistic bet. It is not about swinging for the fences. It's not about trying to predict the future with 100% accuracy. And honestly, this quote from the memo just says it all perfectly. It is not a bet on Visa's explosive growth, but rather a disciplined bet on stability. The goal isn't to hit a grand slam, it's to consistently hit singles by selling insurance during short periods where a big disaster is just highly, highly unlikely to happen. And all of this leaves us with a final, really interesting question to think about. This whole breakdown was less about Visa the company and so much more about its specific position on the calendar. It really makes you wonder, in the world of investing, is carefully timing your entry and exit around these known events just as important as picking the right company in the first place? Something to think about.